Ed Yardeni, what's your most important chart right now? You and I are having a cup of coffee with Ed Hyman, and you say, Ed, this is the chart that matters. Which one is it?
Well, I think it's definitely the consumer inflation charts. I like to look at whatever is available there. And one of my charts shows a consumer price inflation as picked up by the PPI, which does not include rent. And then, of course, there's the CPI, which comes out a little bit sooner than the consumption deflator. But that's the other one I like to watch. And the CPI gave the market some hope that on a year-over-year basis, it may be peaking in August. But on the other hand, the consumption deflator continued to move higher, and so did the PPI numbers. So I think Powell must be looking at that same chart because he just recently said that he's frustrated by the shortages, and that he now thinks that because of the bottlenecks in global supply chains, that inflation may be more persistent and less transitory than he thought. So he's clearly moving away from the base effect,
Right.
and now talking about shortages.
Do you find the vogue of transitory to be frustrating?
No, I mean, I tend to be very data dependent. As I guess that was a term that the Fed once used, maybe still uses. But I just go along with the data, and the data is telling me that some of the transitory stuff was correct. We did see airline fares go up a great deal on a year-over-year basis, motels, hotels. But, we're getting past the point where we can explain inflation with a base effect. Maybe March, April, May, June year-over-year comparisons are relevant. But here we are in August, going into September and October, and I think it's pretty clear that inflation is going to remain elevated, and that'll be an issue for the bond market, the stock market, and because it's an issue for the Fed.
And this is widespread, Ed. It's not just one asset that is seeing price inflation, whether it's financial or otherwise, but a huge driver has been the price of oil, with the prices at the highest going back to 2018. Can you give us a sense of how this factors into Fed expectations based on the fact they usually strip it out as transitory, but perhaps this time is different?
I think that's one of the reasons that the Fed, especially Powell, seems to be willing to now talk about it being more persistent, because it clearly is spreading beyond the base effect issues. It's spreading into energy, it's spreading into food. It's all kind of interesting that how things have kind of played out here. We had an amazing amount of fiscal and monetary stimulus in reaction to the pandemic, which initially was great because it really revived demand for goods. And now we're seeing some improvement in services. But the demand shock, as I see it, caused a supply shock. We've never shut down an economy the way we did early last year. We've never reopened it the way we did. And the result has been a pretty widespread inflation problem. We've seen it in commodities, and now we're seeing it in the energy area, which is particularly worrisome because that's reminiscent of the 1970s.
Well, could you talk a little bit about what you are looking for in terms of oil prices, especially because there isn't the knee-jerk response to prompt more supplies. Basically,
Right.
You're not necessarily seeing more companies pump because of the pressure to reduce fossil fuels, because of some of the activist measures taken by the likes of the one that was in the news today, engine number one. How much does this dovetail into a pretty high price for oil for the longer term, in your view?
Well, one of the sectors that's been starved for capital clearly for the past couple of years, and has to do more with than the pandemic lowering the price of oil there initially. But as you said, the climate change activists have been very successful in weaning us off of oil and gas. The problem is the alternatives, the renewables, haven't increased supply as much as we need in energy, and they're not that reliable. I guess we're still waiting for batteries so that all this energy that can come from the sun and wind can work. But in terms of the price of oil itself, I think OPEC's going to step in here at some point. It's not in their interest to have the price of oil go to 100 or higher and cause a global recession. And so I think we are going to see OPEC increase production here, and 80 to 90 may be kind of the top, I hope.
Ed Yardeni, the work of Meghnad Desai at London School of Economics is centered around profitability. What do you make of the absolutely unusual profitability of our dynamic in growing tech companies, not the many tech companies, but the few, the FANGs or whatever you want to call them. It's a profitability you and I never envisioned. What should we
Correct.
make of that?
Well, it's a huge difference between what we saw in 1999 when the tech bubble got inflated and the earnings story was really not there. And in some ways, it was phony in all sorts of accounting ways. This time around, the Magnificent Five, the big tech names that have now basically absorbed 26% of the market cap of the S&P 500, all-time record high, they actually have earnings. They have market share. They also have regulators breathing down on them, saying, hey, this is where the money is. Let's go regulate it. So they've got some challenges, but they've certainly grown dramatically, both in earnings and in market cap share.
How important is it that they have a relatively small pool of workers relative to their earnings? Basically, that they are not necessarily subject to the same pressures that some of the big employers that, for example, Walmart might be, because they have to be paying more than where they have for the minimum wage.
That's a great point. I think it's spot on. I mean, your question is really the answer. They are small in terms of the number of people they employ. And the number of people they employ, those people are very educated and highly trained, and they work together really well. But I want to make a point here, and that is all companies are technology companies these days. If you're not using technology to increase your productivity, to augment the mental and physical productivity of your workers, you're going to go out of business. So I tell investors, when you look at your portfolio, look at it as are all the stocks I have in there tech companies, and they don't have to actually make software and hardware. They have to use it to increase productivity. And I think they're doing that.
Ed, very quickly here, we've got to get to another important topic, but this is way, way important. How do you respond to the gloom crew, the go-to-cash crew?
Well, and I've been bullish since 2009, so I may very well overstay
I think you got that
welcome.
Right, but yeah.
I may overstay my welcome here, so beware. And when people ask me, do you put money into the market now? I tell them it's not exactly early in the bull market, and valuations are stretched for sure. But I think in terms of the long run, earnings are going to grow 6 to 8% at least. You might actually be able to do better because the margins have been so strong. And valuations probably are about as good as they're going to get. So I think the market still can continue to go up. And I think it's very much become a stock picker's market, much more so than kind of broad-based themes. Look, now you can probably make money on a relative basis in energy and financials because bond yields are going up and oil prices are going up.